Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about WEATHERFORD International PLC quarterly report. Weatherford International PLC offers a wide range of businesses and services to the energy industry. These include equipment and services for drilling, evaluation, completion, production, and intervention of oil, geothermal, and natural gas wells, managed pressure drilling, and directional drilling services, logging and measurement services, while drilling, tubular handling, management, and connection services, cementing products and completion tools, well construction and completions services, intervention and remediation services, artificial lift systems and software solutions, pressure pumping, and reservoir stimulation services. These services are categorized into three main segments: drilling and evaluation, well construction and completions, and production and intervention. Weatherford International PLC's stock price has experienced a significant decline over the past year, dropping by over -10.51%. Several key factors have contributed to this downturn. Firstly, the company reported decreased financial performance in Q3 2025, with revenue and net income declining by 13% and 48%, respectively, compared to the same period in 2024. Additionally, Weatherford missed earnings per share (EPS) forecasts in its Q3 2025 report, posting an EPS of $1.12, which fell short of the expected $1.18. This miss contributed to cautious investor sentiment and a subsequent stock decrease. The company also faced softness in international activity, particularly in key geographies like Saudi Arabia, which led to a decline in adjusted EBITDA margin. These factors have collectively put pressure on Weatherford's top-line results and longer-term growth prospects, ultimately contributing to the stock price drop. The primary drivers of revenue growth or decline can be summarized as follows. Revenue decline is primarily driven by a significant drop in Latin America region, 85%, which accounts for most of the decline. Within this region, lower activity in drilling-related services and managed pressure drilling activities have also contributed to the decline. On the other hand, revenue growth is driven by the DRE segment, which has seen a remarkable 196% revenue growth compared to the previous year. The WCC segment has also shown significant growth, with a 19% increase in revenue over the same period. Net income and profit margins decline. Due to revenue drop, the company's net income has experienced a significant decline of 47% in Q3 2025 compared to the same period last year. This decrease is also reflected in the year-to-date figures, with a 25% drop from $426 million to $318 million. The operating margin has also decreased, falling from 17.3% in Q3 2024 to 14.5% in Q3 2025. The primary reason for this decline is a decrease in revenue, which was partially offset by lower costs. This indicates that while the company has managed to reduce its expenses, it has not been able to compensate for the loss of income. As a result, net income and profit margins have taken a hit, highlighting the need for the company to focus on increasing revenue growth in order to recover from this decline. The company's financial performance indicates a consistent generation of positive operating cash flow. In both 2025 and 2024, the net cash provided by operating activities was substantial, with $408 million in 2025 and $543 million in 2024. This trend suggests that the company is efficiently managing its operations to produce significant cash inflows from its core business activities. The company's debt level and interest expenses have shown some fluctuations, but do not indicate a significant change. The current portion of long-term debt has increased from $17 million to $126 million, while the total commitment amount under the credit agreement has also increased from $720 million to $1 billion. However, the long-term debt itself has decreased from $1,617 million to $1,462 million. In terms of interest expenses, there is a slight decrease in net interest expense and interest paid compared to the previous year. The expected interest payments for 2025 are also lower than the previous year's actual payments. Overall, while there have been some changes, they do not suggest a significant shift in the company's debt level or interest expenses. Management's outlook on company strategy in light of the Russia-Ukraine conflict. Management is reassessing its operations in Russia, considering various options including compliance with laws and sanctions, product/service changes, or divestment. The energy services industry is expected to shift towards national oil companies and diversified energy sources due to a focus on energy security and resiliency. In response, the company plans to invest in technology and infrastructure upgrades, strategic mergers and acquisitions, and personnel costs. Management also expects sufficient cash from operations and cash on hand to fund its requirements, both short-term and long-term. The emphasis will be on capital discipline and operational efficiencies worldwide, exerting downward pressure on demand for services and products in the near term. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In recent years, it has paid out significant amounts in dividends, with $54 million paid in 2025 and $18 million in 2024. Additionally, the company has made substantial share repurchases, totaling $94 million in 2025 and $50 million in 2024. These actions demonstrate a commitment to rewarding shareholders through both cash distributions and reducing the number of outstanding shares. Concerns about inventory buildup and supply chain disruption are present in the financial summary. Inventory levels have increased by -$17 million, resulting in $8 million in Q3 2025 and $22 million in YTD 2025 charges due to imbalances across geographies driven by geopolitical conflicts, investment variances, and supply disruptions. However, there is no direct mention of significant supply chain disruptions. Nevertheless, tariffs and trade disputes have been identified as a contributing factor, along with industry-wide reductions in oilfield services spend and activity in Mexico and North America, as well as project delays in various regions. That concludes the financial summary for WEATHERFORD International PLC. Feel free to comment below, and I will be happy to answer them when possible.